Hi, my name's Keegan Rezek from the Lending Alliance. Unless you've been living under a rock this week, you've no doubt seen a lot of media attention around the cash rate increase. So off the back of this and getting a number of questions from our clients, as well as sort of being a little bamboozled by some of the headlines that I'm seeing in the media, I thought it'd be good just to sit down, quick 5-minute chat, talk through what's happened, what we're seeing, and possibly what we think we might see. Key word there is key phrase I should say is what we might see. Now, anything that you watch or read, take it with a grain of salt and use it to help form your own opinion. And a lot of the reason why I come across and say that is because at the start of COVID, there was a lot of people coming out and saying that housing prices are going to crash, it's going to be doomsday, it's going to be this, it's going to be that. And we've seen the entirely opposite of that. And that was coming from very reputable economists working for major corporations and major banks. So, just as, take what they say with a grain of salt, take what I say with a grain of salt. But I'll sort of give you the background as to why I'm saying what I'm saying. So, with the media hype, be mindful of the fact that they make their money off sensationalist headlines, clicks, views, shares, all of that sort of stuff. So let's look at the facts. The facts are we've had a 25 basis point increase, which means that if you've got a variable home loan, your bank has increased your rate, or if they haven't done it yet, you better believe they'll be increasing it very shortly. Now, on that note, why would a bank not do it right away? Some banks try and hide out of the media spotlight and then softly just sort of, once it's died down in a few days, they'll increase it and sort of try and stay out of the spotlight so that they don't get quoted in media articles. And that's pretty common. We see that all the time. And for those of you on a fixed rate, this will not impact you right this moment, but you will feel the impact when your fixed rate rolls off because the variable rate that you roll off to will be a higher rate than what it was a week ago. So I'm going to flash up on screen right now just a quick little table I put together to show sort of high level monthly repayment increases for those that are on a principal and interest loan. You'll see I've got a couple of columns. I've got a 30-year, got a 25-year, and then I've got a 20-year term remaining, because depending upon when you took out your loan amount, it's going to have an impact on how much your monthly repayment increases. So have a quick squiz at that. You should be able to get a rough idea there. Multiply it by 12. That's the annual increase you're going to see off the back of this change. Now, that moves me to the next point, forecast. As at today, not speaking in absolute terms, but we're looking at 2-year fixed rates around 4% currently. That's the carded rates for some pretty well-established banks. And that would suggest that variable rates are heading in that direction. So if we've had an increase now, we're likely to see further increases off the back of cost of funds going up and inflationary pressures and a bunch of other economic factors that, I'll be honest, is well beyond my pay grade. But if we're talking about rates being at 4% 2 years from now, we're going to be seeing multiple rate increases. That's my feeling. So you can use this to, that table I was showing to basically say, okay, well, if it increased by that much, with that increase, if we have another increase, it's going to be same and same and same again. And it will allow you to budget for that. When you took out your home loan, the assessment rate that determined how much you could borrow from the banks did have buffers inbuilt. So in theory, for the most part, most people should be able to absorb these increases, but definitely be aware of what you're going to be up for so that you can make any adjustments necessary to possibly plan for the future as well. High level, most banks put a 2.5% to 3% buffer on actual interest rate. So if you were paying 2.5%, the bank would have been servicing you at 5.5% to 6% interest rate for most situations. Now, should I fix my home loan? Should you fix your home loan? Only really you are going to know if that's the right decision for you. I can give you the pros and cons. If you go down path A versus path B, what does that mean for you? For me personally, the way I interpret it, and I go, well, you've really got to want to fix to commit to a quite a bit higher rate in the interim. And that interim I'm talking about is this theoretical gap that we're sort of looking at of variable rates here being lower than fixed rates the fixed rates that we're seeing up there. So if we're seeing the variable rate increase over time, you can still be paying a little bit less in the meantime. You'd probably only really be fixing if you were really worried that rates were going to balloon well beyond the carded fixed rates at the moment. But like anything, on the way up, even if you fix now, when you roll off in 12 months, 24 months, or 36 months, depending upon how long you decide to fix for, you still need to be mindful of the fact that that variable rate you're going to be jumping on the variable rate at some point, or you're going to be jumping on new fixed rates which are determined off the market at that particular time anyway. So fixing your home loan might be some food for thought, but I'm seeing a lot of people sort of take the wait and see approach. And people ask me personally for my own home loan, what am I doing? Well, my fix actually rolled off probably about a week or two ago. I'm just staying variable for the time being and just taking that wait and see approach. Should you refinance your home loan? Another question that I'm getting. Well, refinances and equity releases are always going to be a strong majority of what we do day to day. A lot of people think of mortgages from the perspective of new purchase. And yes, we do a lot of new purchases, but we also do a lot of refinances. That might be restructuring, for restructuring purposes. It might be for getting a better interest rate, and it might be for releasing equity, doing some additions or updates to your property. That will still remain, and that market will still be as busy as ever. If not, my prediction is it actually becomes busier through this, mainly off the back of all of this media draws people's attention to their own personal finances. There's a lot of people day to day that don't really take a keen eye towards it, whether they're not interested or they don't understand. There's a number of factors. But this really draws people's attention to it. And I'm getting asked the question from friends that have never really asked me much about what I do, but now they're sort of going, hang on, okay, well, my back pocket's going to be impacted. Let's try and speak to someone who is in the industry and sees all of this stuff on a day-to-day basis. So in summary, I know I've sort of talked for quite some time here, but I'm really mindful of sensationalist media. I don't like it. I think it's counterproductive, the scare tactics and whatever we see, because at the end of the day, the sun's going to rise tomorrow, we're going to wake up tomorrow, you're going to be going to your job tomorrow or building your business tomorrow. We will be thrown curveballs along the way, and we just need to adapt. And if it makes people feel better about it, we're all in it together, right? So it's not a matter of I get impacted and you don't. We are all going to be impacted, whether it's today on a variable loan or tomorrow or next month or whatever when you roll off a fixed rate loan. So I think the more people understand, the more we can prepare, and the more realistic and more truthful information can sort of be conveyed to you, and then you can form your own opinions and your own sort of path off the back of this. So I think with the market that we're in and moving into with an upward increase, I'll do my best to sort of give feedback along the way, mainly because people ask me for it. I think I'd rather put it out there, and then that way more people can see it. And just on the last point, I think people need to remember that it was only really 3 years ago that a market leading 2-year fixed rate was high threes, 4%, 3.69 to 4%. People just very quickly forgot about that when we were seeing fixed rates in the 1.89%. And the reality is you can only go up from the bottom. So as we move into this new stage, the rates as they are now are still extremely low. And there may be impact to property and things like that, as borrowing capacity will be impacted slightly. But overall, I think wait and see is the best sort of advice I can give to people. So if you've made it this far, really appreciate you taking the time to watch this. If you've got any particular questions, I will put a direct link to my calendar. Feel free to lock in a time there and we can chat about your personal situation in particular in a bit more detail. Thanks so much. Bye.